Hello and welcome to this month's episode of Third Thursday 30, the monthly program that is designed to provide you the information and insight necessary so that your money supports your life the way that you want it to. Today I come to you and talking about a kind of a timely discussion as opposed to a more conceptual discussion as we've had before. And the last couple of discussions have been broader. What I want to talk about today is taking the context of where we are right now in the market into perspective. Okay, as we sit here, as I'm recording this in October of 2019, we are kind of at a point where we are celebrating an anniversary, as it were, an anniversary, 12-year anniversary precise, of when the S&P 500 started its downward crash toward the ultimate bottom in 2019. And we're going to talk about that in the context of your 401k and what you need to be doing to protect yourself. As we are now sitting at the tail end, potentially, of a long-term, almost historically long-term bull market. So let's get some perspective, shall we? October 9 of 2007. Put yourself in the position of being where you were back then, okay? Maybe sitting there in your office and not quite sure what's going on out there. You're not really feeling what's happening in the market, but that was when the S&P 500 had its pre-crash high. About 1,500 was what the rate was at that point in time. And that began sliding down. And it took about 15 months to hit bottom. Okay, the bottom was in March 9 of 2009, when that what was 1,565 now went down to 676. Now let that sink in just a second, and what that would feel like where you are now if you were watching that go down for 15. Okay, now also what goes down might come up, right? Historically, it's always come up. That's why people tell you to buy and hold. Okay, but that market did not get its value back until March 28 of 2013. Now again, let's let that sink in for a minute. You're sitting there today and you have your money in your 401ks that you are now a few years closer to retirement than you were back in 2007, right? Now project forward. If I were to tell you today that what you put in there was not going to grow for the next 5.5 years, would you sit back and let that happen to you? Okay. No, right? The purpose of our conversations in this forum are to make sure your money supports your life the way you want it to. And I'm pretty sure anybody that's listening to me here today does not want to be in the same financial status in 5 years as they are now. We're trying to grow for retirement, trying to grow for our future. And when you have your money in 401k, you may be on for that ride of 5 years until you get back to the baseline. So let's talk a little bit about 401k and what you can do to protect yourself. As I said, we are now in a historically long bull market. Okay, and we're going to show you today a little bit about how that really translates into your wallet. But understand that the fundamental underpinnings of the market are very stressed right now. I can't tell you when the market will crash. I would be a fool to even try. And I'm generally a positive guy. I think that things are going to be headed toward a bright, shining future. We got a lot of good stuff going. But I also have studied the markets. I've studied history. And I'm not a fool to ignore history. And that history shows us that every time that we think we've got this thing figured out, the market whacks us upside the head. It happened before. It will happen again. Ask yourself, as you are now looking forward from where you are now, will it happen? All right. So, what is a 401k? Who designed these things? Why am I relying upon this for my future? Well, 401k is not a bad thing. Okay? But a 401k is not really a deliberately thought out saving strategy for you and for your future. See, a 401k is the byproduct of the mass marketers. Yeah, folks, 401k was not really something that was designed as part of a deliberate process to prepare you guys for your retirement. No, rather, 401k was a kind of a lost section in the federal tax code until some entrepreneurial marketers, you can call them financial advisors if you want to, saw it and figured, hey, we can figure out a way to make this attractive to the businesses. All right? They were able to go to the business owners and say, hey, right now you have the risk for your clients, your employees in their retirement, the pension. And they said, we can do better than that. Through this 401k process, we can offload the risk from the employer to the employee. Now, I'm a capitalist, okay? I'm a free market kind of guy. I believe in the stock market, all that kind of stuff. But that fundamental change was done without really being fully thought through for the benefit of you, the employee, participating in 401k. They thought that they'd be able to clean that up a bit, all right? But understand where we were at in the early 80s when that started coming to market. Historically, the market had crashed many times. And the marketers had a problem because the clients or the employees that they were trying to sell this to had a long memory of what had happened before in the market. Multiple crashes, losses. History is full of them, and that'd be subject for another show. So they had to dumb it down. They had to find a way to sell it to the consumer, the employee, you. And they did that through developing these nice little pie charts and going back to a philosophy that was developed many years before based upon a much different economy than we were experiencing then, let alone than we're experiencing now. And that's where the pretty pie charts came from. And when they did that, that created a explosion in the mutual fund market. Where we used to have hundreds, there became thousands of mutual funds. And they went to the employees and said, as long as you have those in proper percentages, you would be fine. Well, we found out that you weren't fine. We found out in subsequent crashes that that philosophy didn't work. So the marketers had to find another solution. Because not only did that fundamental diversification model fail you, you started becoming more savvy. You started to be disciples of people like Bogle and Vanguard and learned how the expenses in those mutual funds were really a drag on the performance. So now we enter our current era where the emphasis is on low cost. Exchange traded funds, low cost index funds, et cetera, et cetera, et cetera. And that's a step in the right direction. But within the context of your 401k, they're still not giving you the proper guidance on how that should be allocated and managed, especially in times like now where those funds are going to be stressed if the market or when the market has a correction. So what they've done for you now is they have put you into situations where you have even less management of those funds so that you are more likely to ride that down with the market. Now, I've done a lot of reading. I'm a student of the market, student of history, etc. And Warren Buffett gets a lot of credit as being one of the most savvy investors of our time. I don't disagree with that. Warren Buffett has two cardinal rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And you and your 401ks right now are set up to violate that cardinal rule. because you will lose money, period. It's a matter of how much and how do we do this. Okay, so with your 401k, I'm going to talk to you about 5 different things that we can look for to try to manage this problem and eliminate some of the risk that you are facing in your 401ks. Because what we need to be doing is taking management, taking control over our financial future. They put it in our hands, folks. And when you are sitting there across the table from your financial advisor that comes to you from the 401k provider, you're not really sitting across from an independent advisor. You're sitting across the table from a representative of that company that has a vested interest in keeping you in that company's funds. Period. End of story. Okay? So, what do we do? Now, first of all, again, 401k, it's not a bad thing in and of itself. We know human nature. If we didn't have 401ks, many of you would not be saving at all. So it's a good start. But it's not the best place. So, the first thing that we need to be thinking about is in the modern economy, you change jobs many times. You may have 401ks from prior employers that are sitting out there that have been rolled over to IRAs. Great. Now, many people, in my opinion, make the cardinal mistake of when they change jobs, they roll that old 401k into the new 401k. They think that's the right decision because they're not guided. And why do I say that's the wrong decision? Because when you have an old 401k, you have the opportunity to take control over those funds. Take control and manage them either individually by yourself or through professionals in a fashion that will protect you from that loss. You see, when you move those funds into a new employer 401k, then you are limiting the universe of what you can put it into. You are limiting the investments to the selection that the new employer has for your investments, which is not made based upon what may be the proper choices for you at that time. If you have those funds in your own IRA as opposed to rolling them into a new employer 401k, then you can control what happens. You can put it in defensive funds, you can put it into aggressive funds, you can put it into the bank. You have control. So, rule number 1, when changing jobs, think twice. Do not just automatically put the money into your new employer's 401k plan. Okay? All right. Now, you got money in your employer's 401k. What can we do? As I contend, we have a current investing environment where the potential for a major correction is on the horizon. What do we do now? First of all, depending upon your age and all that kind of fun stuff, you need to be considering what you've got your investments in within that 401k. You see, one of the things that has happened as a result of the increased emphasis on low cost is that more and more of you are putting your funds into what they call target date funds. You may recognize it on your 401k menu of investment items as a Vanguard 2025 or Vanguard 2030 or whatever. And understand what that is. That is a portfolio that will automatically change over time, that is designed as if you are going to take your retirement starting upon that date stated. So, a Vanguard 2030 fund is basically managed by Vanguard with the expectation that you will be starting to take your money from that account in 2030. And what that means in the industry then is that they are going to automatically be increasing your amount of the portfolio that is in bond and reducing the amount that is in stocks, because theoretically that has less risk. So if you're listening to this program and you're in your 20s, 30s, maybe early 40s, when retirement's far on the horizon, then those target date funds are probably one of your better choices because they are at low cost. And at that point in time, if you don't have a significant value in your 401k, that makes it somewhat reasonable on how that should be managed. Now, as you start accumulating more, you're going to want to do that yourself. Instead of having it in those target date funds, you're going to be wanting to blend your own allocation, as we'll talk about in a minute. If you're older, let's say you've got a 2025 or maybe a 2030 even target date fund that is you're holding your funds. Understand where we are right now with regard to the bond market and where we are at the stock market. Stock market is risky as all get out right now because we are at the tail end of this bull. And the bond market is struggling because of the interest rate environment we're in. So essentially, what you have done, if you are in one of those funds, is you have a double exposure to risk, whereas historically the idea was that the bond would outweigh the risk of the stock, et cetera, so that you had some type of counterbalance there. That's not happening. So if you are in one of those funds right now and you are within shouting distance of retirement, you're going to want to think twice about staying in that fund. Okay. Now, with regard to a fund allocation, discussing fully what goes on with diversification, all that stuff, is well beyond the scope of what we're able to talk about today. But I want to kind of give you an example. I'm going to show you something that is some people kind of alarming. So what I'm going to show you here, I know many of you are listening to this in podcast form, so I'm going to kind of describe what I'm showing here. Some of you are sitting there on the monitor. So if you can see this, what I'm showing you here today is a traditional bond and stock portfolio. Just for ease, 70% of stock and 30% of bond. And this graph is going back to 2000. Okay, so this is showing us that from October 1999 through October of 2019, the last 20 years, if you had that type of a portfolio and you just had the old buy and hold philosophy, over that 20 years, you'd have an average return of 5.18% per year. Now, just for a second, folks, can you appreciate the fact that for 20 years, a portfolio that was 70% in stock and 30% in bond only had 5.18% return? Now, this calculation that I'm showing, and I'm getting that off of, does have a fee that I've put on that. So actually the number would be higher. But this is a 1.5% fee that I've assessed for this model. And that's very, very similar to what you would be seeing in your 401k. So what's this all? This is if you are a traditional, typical investor and you started your investing journey 20 years ago, at the time where, let's say you were in your 30s, 70-30 would be pretty close to what you'd be doing. And 5.18 is what you'd be receiving over the lifetime. So over that 20 years, $100,000 that went in would have about $274,000 at the tail end. Think about that, 20 years. You see, what happens is the drawdown, okay? And we need to be mindful of that. And let's show you this real quick here. You see, with a traditional fund like this, we have our years, like our 2008 to 2010 period that we started out our conversation today talking about, that we had to recover from. Now, If you started this in your 30s and we are going through today, then okay, maybe that's all right. But if you are now in your mid to late 50s with retirement on the horizon, again, do you want to be in the same place 5 years from now as you are now? The answer clearly is no. So how do we avoid this if we do have our money stuck in our 401k? Well, our answer is that we have to be more aggressive about how we manage our own portfolios and diversify. And putting it on autopilot doesn't work. Another night, another day, we'll talk about diversifying and how to do that. But for now, just understand that where we are in the market, you can't afford to put your head in the sand and ignore your 401k statements. Now, let's talk about options outside of your 401k. What can we do to address this situation so you are not facing these kind of losses over your time? First of all, you need to check with your current employer and see if you have an option in your portfolio management for your 401k that is called a brokerage window or something similar to that. And what that does for you as the investor is it gives you an opportunity to use the structure of your 401k, but to have an outside investment account. An outside investment account that you can put mandates on to your investment advisor to manage it in such a fashion that is taking consideration for what's going on in the market and not simply going to sit back and watch you get whacked when the market adjusts itself, as it always does. Because folks, if you are in your mid to late 50s, you do not have the time to recover. It's even worse if you are closer to retirement. Now, maybe a conversation for another day to show you exactly how that impacts your ability to take income out of your account and how that can rapidly decrease your savings in retirement if you are in a bear market. But understand that there may be the opportunity that through using a brokerage window with your current 401k, that you can find an advisor that will look to manage your assets with what we call forward-looking due diligence, where we don't really give a rip what has happened in the past and how a fund has performed in the past. We want to see how it's going to prepare you for the future and what's going on in the market right now. So, brokerage window, if you're still in your 401k, you want to check and see if you can do that so you can get some greater investing options. The second thing I want to talk to you about in terms of kind of escaping your 401k is a rollover from your 401k while you are still in employment. You see, when you check your 401k documents at work, you will find many times you have the opportunity to do a rollover and still be in employment. So at age 59 and a half, a lot of magical things can happen to you. One of which is in your 401k, you usually are able to roll that out to your own IRA. So you can roll that out of your current 401k into an IRA. No, there is no tax ramifications. This is a rollover, not taking a distribution. So if your employer allows you to do that, then you can take that money out, put it into your own IRA, and have it managed in a defensive manner. Okay? You can put it into some guaranteed type devices if you wish to, or simply look to those forward-looking due diligence type of investments, or just knowing that you've got somebody there that is not going to ride the market to the bottom. So that's tool number one in your arsenal if you are over 59 and a half. That allows you to get control over that investment, take advantage of good times, and protect against bad. Now, what happens if you're not 59 and a half? So if you are employed and you have a significant 401k balance and you're married, you may want to consider taking a non-traditional step, a step that many people do not know, a step that is involving the court system. See, that's my bailiwick as a lawyer. You have the opportunity, if you are married and have a 401k, that you can go to court in your state, your county, and you can get an order from that court that says, we as a family are taking control over our financial future. We are using this court to allocate those funds as we want them allocated. Set up another IRA, and the money's going to get moved into there. So, husband and wife have $1 million in their 401k. They are in their mid-50s, and they are scared to bejeebers that the market is going to go down south. And they don't want to play catch-up down the road. They've done their accumulation. They may want to focus on an early retirement, and they're at risk. So, through a judicial process, we are able to go to the county court and say, court, we want to go ahead and separate this IRA, this 401k, and have the same thing that is done in the context of a divorce. It's called a qualified domestic relations order. That orders Fidelity, Vanguard, whomever your 401k provider is, to separate some of that fund out. And then we put it into whatever needs to be put it into to manage it, to protect you, protect your growth that you've experienced over these years. So, folks, as the mantra of this show is to give you the information you need in 30 minutes or less, and I am about at that point. I just want to recap a little bit here. So, first of all, 401k, it's a necessary evil, okay? If you are currently still early on in your accumulation cycle, you want to look at those target date funds because they do give you a low-cost alternative. If you started accumulating in there and you got, call $100,000, you might want to go ahead and evolve out of that into your own allocation, diversified, that you would be looking to rebalance on a regular basis. Because if you've done that, then if you see the market is going down south, then you can take some defensive action. Difficulty with that is when do we get in, when do we get out? Nobody has a crystal ball. Rule of thumb, anything over 10% is a fairly significant risk factor that it's going to go farther than that. So under 10% is what's considered a correction in the market. Over 10% seems typically is a major event that's going to go past that. If you're farther on in your investing life, then what you want to be doing is, if you are at 59 and a half, you want to be looking to see if your employer does offer you the opportunity to take that fund and roll it over into your own IRA so that you can take management over that. If you are between, call it 50 and 59, married, and you've got significant accumulation in there and you don't want it all to be at risk, then consider a judicial alternative that will allow you to move that money into your own management without incurring taxes on it. Folks, I am not Chicken Little. The sky is not falling, but we must pay attention to the factors that are out there that are indicating that something major may happen, and we know that the market always does whop us upside the head. So, with that, have yourself a good month, and I will see you next month for Third Thursday 30. Take care.